In this screencast, we'll talk about the policy rate with a limited reserves system. In this screencast, we'll understand what is a limited reserves framework. We'll look at the reserve market graph, and we'll look at the different parts of the demand for reserves curve, and we'll also identify the policy rate on the reserve market graph. So a limited reserves framework is when reserves are limited, meaning that they're not abundant. What the central bank does is they set a reserve requirement that's above zero, and then you have banks that are fully loaning out their excess reserves, and they have to keep a certain portion of each demand deposit in their required reserves. But banks sometimes can't meet the reserve requirements. And if they can't, then they have some different ways to be able to increase their reserves. They could call in loans from customers. That's an asset. They could sell other assets like bonds that they currently own. They could borrow from the central bank, and remember that interest rate is called the discount rate. Or they could borrow from other commercial banks, and that interest rate is the policy rate. Central banks try to set a target range for the policy rate in order to help guide monetary policy. And one of the ways in this listing here of how monetary policy can be used is with the selling of assets. For example, the central bank could buy the bonds from the bank. And obviously the discount rate would be another one that they could use. A thing to remember when looking at the reserves graph is that the policy rate is also known as the overnight interbank lending rate. And in the United States, we refer to this as the federal funds rate. So here is the reserve market graph. There's three different segments that go along with the demand for reserves. And the demand for reserves are by financial institutions. The vertical line here, which we'll talk about later, is the supply of reserves by financial institutions. In the first segment here, this upper portion, you have a horizontal part of the demand for reserves. This is where the discount rate is the ceiling. It's a ceiling because commercial banks will not demand any loans at a rate that is higher than the discount rate. In this downward portion part of the demand for reserves, this is our limited reserves framework. This is where you can see that as you move along with the quantity of reserves, you have a change in the policy rate. As the policy rate decreases, the quantity of reserves increases. As the policy rate increases, the quantity of reserves decreases. This lower portion of the demand curve, this lower horizontal portion, is known as the interest on reserves. If banks put money in the reserves at the Fed, they can earn interest on that. So this interest on reserves is the floor. It's a floor that commercial banks know no other bank will loan at a lower rate. When we look again at these three different segments of the demand for the reserves, in this first higher portion here, where we had the ceiling, this is where you have really high policy rates. And again, the policy rates are known in the United States as the federal funds rate, so that interest rate that one bank charges another bank, or the interbank lending rate. When the loans are high, when the rates are high, the loans from bank to bank are really low. When you have this downward portion part of the demand for reserves, which would be our limited reserves portion, this here is where there's a low policy rate. And what you see is that as the policy rate decreases, the quantity for reserves increases. This causes the loans from bank to banks to be higher. This third portion here, this lower bound horizontal segment, this is the zero bound reserve requirement. Remember, in a limited reserves, you have to have a certain portion. You have to have a reserve requirement above zero. And so this you can't have in the limited reserves framework. If it did turn into this portion, that's then when the central bank would shift over into an ample reserve system. Because if you notice, as you move along here, an increase or decrease in the supply of reserves, it won't change the policy rate. And the goal of monetary policy is to target the policy rate. The other curve that you have on here is our supply of reserves. Notice that the supply of reserves is vertical, meaning that there's no trade-off between the policy rate and the quantity of reserves that are supplied. The reserves are supplied by the financial institutions, and they are determined by the open market operations, the buying and selling of the government bonds. You can also see here that the policy rate is set by the intersection of the demand for reserves and the supply of reserves. So in the limited reserves framework, we are only talking about the downward portion part of the demand for reserves. If you go to a quantity that is larger or a policy rate that is lower than this amount, then you will be where the central banks will shift over to the ample reserves framework with 0% of the policy rate.